Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, 9 straight years and running, as named by the readers of the Lake City Reporter, the team from GulfCoast Financial Services, celebrating 31 years in serving North Central Florida proactive savers and investors and formulating the plans to achieve your financial goals. Founder and CEO John Kuykendall here with us as always. And John, you spend a lot of your time addressing the concerns, the doubt and worry, and the risks that we face as we transition into retirement. And I think there's no lack right now of concern and worry about our money.
Well, that's right, Peter, with the market being where it is, and all the things going on the economy and the political side, people in retirement are concerned about their money. I think that's why we got that new book, Peter, coming out hopefully soon, that says retirement's not for wimps. And, I thought it would be easy to retire, but I'm finding that my clients are having more and more difficulty with all the things that we're doing. And I think today's episode, talking about dollar cost averaging and the effects of the market, is very important for people to understand the concept. This is a tremendous concept that we're working on. And while it may be a little difficult, if you'll follow along with us today, folks, I think you'll get a lot out of the show because I'm really excited to bring this concept to you.
Well, John, at its foundation, the concept behind today's program, I think, is one that is unfortunately overlooked in our financial educational process. And from a surface level, it seems fairly self-explanatory, but when you look at what we are doing, what we are taught to do with our money, we're not following along with what this clearly indicates we need. So you've stated here that the program concept is about retirement success, and the fact that retirement success is based on understanding there is a difference between our investment plan and an income plan.
That's right, Peter. We've said that over and over again, that there are two things. One is the investment plan and the other one is the income plan. And while we're working, we have an income plan. We may not realize it, but we do. And that's that monthly, weekly, or whatever it is, paycheck that comes in, that covers our bills, meets our needs, and then out of that paycheck, we take dollars out and put it into our 401k, our retirement account, and we don't miss them and we don't think about them. We're actually dollar cost averaging into the market over a long period of time so that we really don't care what the market's doing because we're investing in the lows and the highs, and it works out in our favor. It's a great way to do investing dollar cost average. But in retirement, that's different, Peter, because we don't have an income plan, because what we're doing is we're living on our investment plan and having to pull money out in the highs and the lows of the market.
And John, you made the comment as we were sort of preparing for the conversation, pre-gaming for the show, that it seems like the financial world is falling for that age-old definition of insanity. There continues to be so much doubt and worry because it seems that we are doing the same thing over and over and expecting a different result when clearly that's simply not going to work. It's not effective. It is not the most efficient way to plan for retirement. We have to take steps to recreate the income plan.
Well, that's right, Peter. And as you said, I can be in the swimming pool and decide that I'm going to hold my head above water and I'm going to be able to breathe. But really, I mean, that's really just a small analogy there. But we have to do things differently in retirement. And a lot of people don't realize that. We can't continue the same way we did in retirement that we did while we were working. Because, I know for a fact that people today who are working and have that check coming in, they're not worried about the market. They're putting their 401ks in a drawer, as they say, and looking at them later. So they know that it's going to work out because they still got their bills covered. But in retirement, we have to find a way to cover the bills, but also make sure that the money lasts us for our retirement. And so while we're taking money out in a down market from our investment plan, we could end up over 20 years, Peter, losing a third of our balance. So how would you like it if you had $1 million and all of a sudden, here you are 20 years later, you've got 330,000 left to last the rest of your life, including long-term care and all the things that we know are going to happen.
Yeah.
It's not comfortable.
No, that's going to erode a lot of confidence. I sort of rhetorically asked myself as we were looking at these numbers, John, at what point in my retirement am I going to be comfortable seeing a half of my starting balance, right? Is there any point? Because we've still got an unknown number of years into the future. What kind of quality of life am I going to be able to have relative confidence in spending and achieving if I've seen that balance go down by half due to spending or market volatility or a combination of the two? And John, specifically, the combination of the two can be significantly detrimental.
Well, that's true with the market and with us pulling 4% or 5% out of our investment account. The effects of our investment account are devastating. We won't have enough money to last us through retirement. There's no way. It just doesn't work. We've proven that over and over again mathematically. And so what we have to do is come up with a way that we can smooth out the downside and make that money last. And one way we do that, Peter, is with the income plan we talk about. We have to have a retirement income plan that helps us get through that downturn and gives us enough money so that we have all of our needs are met with predictable, sustainable income. And then we have a growth bucket that's going to take care of inflation and all the extra things that we're going to need, and the healthcare cost and all the other things.
And John, we always talk about how you bring a dose of common sense to the financial world. It seems like the rest of the financial world seems to be falling not only for that definition of insanity, but you and I talked about that swimming pool analogy. If we do something completely different, we should not expect the same results. And so when you're in that pool, if you dunk your head below water, you wouldn't expect to continue breathing the same way just fine. And yet what we're doing is we are doing the exact opposite behavior. We are placing opposite pressures on our portfolio and then expecting everything to work out just fine like it did when we had a paycheck. And that's simply not the case. And it's really why we need to understand the difference between the investment plan and the income plan, work specifically to recreate the income plan and understand that the direction of our money matters as much, if not more, than the direction of the market.
Well, that's right, Peter. And, one of the things that we talked about before the show started was the graph that shows what we're looking at is if I started with zero and gave a contribution, dollar cost average, the markets had significant returns. And so over that 20-year period, I'm going to show a decent return on my money. Now, if I started and I stayed in the market, I'm going to have less money because the market has been taking away my gains. And so I'm not going to have as much as if I dollar cost average. However, Peter, what it also shows is that if I started with my money and I left it in as the downturns in the market and did 4%, which is my withdrawals, I'm going to have substantially less money because of the sequence of returns. It's going to eat away my principal. We know that.
Again, we've got to understand, ladies and gentlemen, the difference between and the importance of the distinction between an investment plan and an income plan. And in order to address many of the questions and concerns about retirement and about your money and financial stability, you have to carefully and specifically craft, create, and implement the income plan to replace your sweat equity, your hard work, your paycheck, and income producing ability once you retire. That's one of the key fundamentals of success. And that's what John and his team there at GulfCoast Financial Services do each and every day for their clients. And if you would like to have that financially focused written retirement income plan, pick up the phone now, give GulfCoast Financial Services a call, 386-755-9018, 386-755-9018, 386-755-9018, or you can visit online, GulfCoastFinancial.net, GulfCoastFinancial.net. John, it is always a pleasure to see you on the program. Thank you for bringing the important information and addressing some of the more difficult challenges that we face with our money in our financial progress and the transition to retirement.
Well, thank you, Peter. As I've often said, retirement is not for wimps. And so let's get a plan and make sure we take care of ourselves. Thank you.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.